I think we're sort of in trouble when it comes to the markets. I think that the Fed, Ben Bernanke, has placed the Federal Reserve in a trap that they cannot get out of, that there is no way out of this. They can only make it worse.
Hello, GoldSilver family. Alan Hibbard here with another video, and today I am joined by Mike Maloney. Mike, it has been too long since you and I did a video together. How have you been?
I've been doing well, and you are correct. It is too long. I went to Limitless in Dallas. Had a real good time. It was only my second speaking event since I started writing my book, The Great Gold and Silver Rush, that you did all the charts on and helped me write. And so it's interesting being back out at speaking events and meeting people again. So it was a great conference, and I'm back and I'm ready to go.
Awesome. Glad to hear it. So yeah, I know we have some Limitless videos on our channel, but today I wanted to sit down with you. So thank you so much for your time. And I put together a little analysis on the gold bull market and what might be driving it for the last 20 years or so, and sort of guessing if it's going to continue or not. So I want to show you a chart that I just saw on Twitter as a jumping off point. This one here from Incrementum. And just to put it in context, the Fed has just cut rates 50 basis points. And so everyone is wondering, what is that going to do to the price of gold? And you can see here, typically after a rate cut, the price of gold goes up. However, there's something super important that I think a lot of people overlook, which is the bull market in gold, which, yeah, if you say it started maybe in 2015, of course, you could go back to the year 2000-ish. But if you say that it started in the year 2015 and went straight up, look, it happened during rate hikes, rate cuts, rates going sideways, rate hikes, rates going sideways, and now it's going to be rate cuts again. So it almost doesn't matter which way interest rates are going. Gold has been in a bull market, and this got me thinking there must be more to it. Have you thought about this, Mike?
Yes, I have, but I do consider it one big bull market from 1999, 2001, the double bottom that we put in, to today. I'm probably the only one that considers it one big bull market. But I look at something you and I really spent a lot of time on called wealth cycles. And so I'm looking at the bull market as to when gold bottomed against other assets in society. And that was basically 1999, 2000. And it's just on the way to becoming overvalued, but it's still tremendously undervalued when you compare it to the Dow gold ratio and things like that, gold S&P. So stocks versus, and it's gaining ground on real estate. But yeah. So anyway, yes, this chart just shows that there's very little gold is, once it's in this fundamental bull market, it doesn't really matter whether the rates are rising, falling, or going sideways, like you say. Gold, on the average, is rising compared to the US dollar. It's rising in dollar terms.
Yeah, exactly. So I was thinking that if nominal rates aren't that important, maybe real interest rates are. So basically taking these nominal rates and adjusting them for inflation. So that's what I did. So I put together a chart of the real interest rate, basically the Fed funds rate minus the CPI. And this is what I came up with. Yeah. And when it's positive, I have it in blue. When it's negative, I have it in red here. And you can see two distinct groupings, roughly the period of the 1970s, and then roughly the period, like you just said, the year 2000 until present. And we know what those two periods are. They're the two bull markets in gold. So right. let me add gold to this chart, and you can see that gold bull market here corresponded to negative real rates. Same thing with the current bull market that we've been in almost 25 years.
Stay here for just a second. I do want to point out for the viewers that, if you look at the 70s, there's that first red blip of negative real rates. And that blip pretty much corresponds to coming off of the Bretton Woods system, Nixon closing the gold window on August 15th of 71. And then it's blue for quite a while during that first rise. So it's positive real rates. However, that part of the bull market, the US wasn't participating. It wasn't legal to own gold in the US, and it wasn't being traded as a commodity on the Chicago Mercantile Exchange until the first day of 1975. So that blue area, when you're measuring US CPI, gold really had not that much of a relationship to it because it wasn't legal here. It wasn't being traded here. It wasn't the safe haven asset that you run to. But it is interesting that most of that decade when gold was rising, you see the negative real rates. Yeah. Oh, another thing that I want to say is that the CPI became the CPI in the early 80s. And so from the early 80s to today, if you want to sort of make this real, what you've got to do is tip it more toward negative real rates. You got to bring down the today. So imagine 1982, roughly, that peak in real rates being above 8%. From there, just take everything and sort of tip it down just a little bit because it is now the CPI. They fabricate so much information with hedonic adjustment and replacement and just all of the different tricks they do to try and massage the numbers and make them look a little bit better than they really are. And then the CPI doesn't incorporate true inflation where the Federal Reserve, the way they create currency requires them to pump that currency into the markets. It's currency when the Federal Reserve is creating currency. It's going it's going through the biggest brokerage houses in the world, and it's going directly into the bond markets, and that thus once it's in those trading houses and so on, it ends up in the stock market. So they're not measuring that inflation. So this whole thing is actually this decade, these 2 decades are actually more negative than it looks because they're not measuring all of inflation. And then another thing, Incrementum always uses annual data. So it isn't really showing, at least on the gold price, it isn't showing the true peaks in gold there. They're always using annual data instead of, or monthly instead of daily. So we're not seeing the true peaks in the price. So those are the things I see in this chart.
Well, that's quite a bit. Yes. So thank you for that. So really the main takeaway I have here is that, there seems to be a perfect correlation, if you will. It's only a sample size of 2, but when we have a prolonged period of negative rates, we get a bull market in gold. And conversely, we only get a bull market in gold when we have negative real rates. So there seems to be a natural question that emerges, for anyone who holds gold or is thinking about it, are real interest rates going to be negative? Because if you look right now, we're actually positive. We have positive real rates right now. Fed funds rate about 4.8%-ish, and inflation being reported as 2.5. So we have positive real rates. So are real interest rates going negative? That's sort of the question.
But my previous comment is I would call these positive non-real rates.
Non-real, yes. Positive CPI fake rates.
Right. Positive fake rates. That's what it is.
Exactly. Well, yeah, that aside, let's see if we can forecast what is going to happen with the Fed funds rate. And then let's see if we can forecast what's going to happen with the CPI to try to answer our question, given that these numbers aren't perfect. So that's what I want to do in the remainder of the video here. So the Fed funds rate, we have traders who trade the Fed funds rate all the time. And so if we go out to the September meeting of 2025, roughly a year from now, and sort of ask ourselves, what are they betting on? And we have here the current target rate is 4.75% to 5%. Okay, because we just got that 50 basis point cut. And a year from now, this is the sort of bell curve of the distribution. At the low end, somewhere between 2% and 2.25%, but there's not very many traders who are thinking that. At the high end, 3.75% to 4%, but again, not many traders thinking it's going to be there. But you'll notice no one thinks rates are going up. It's just a question of how much lower are they going to be. So around the middle, it's around 3%. And you could say, maybe about, if we added this up, it might be about half of traders below 3%, half of them above, plus or minus. So we could estimate that the Fed funds rate might be 3% a year from now. Does that seem fair?
Yes, it does. I think a crisis is coming, though, and I think we're going to see the same thing as in 2008 or right after the pandemic, right during the pandemic, where they just slam them down to zero. I think that's what's going to happen. But let's go with this. This is good.
Yeah, this is sort of conservative because this is really the free market, right? So this is traders betting money or betting currency on what they think is going to happen, and maybe some of them are expecting a crisis, but the bulk of them are not.
This is usually far more accurate than the Federal Reserve is.
Exactly. So, okay, so that's the first half of our equation. We're expecting that nominally the Fed funds rate will be about 3% a year from now. Okay, fine. What about inflation? That's much harder to predict, or the CPI, specifically. If you had to forecast the CPI, a year from now, let's say, how would you do that?
If I had to forecast the CPI, I would take a look at the currency supply.
Me too. We think a lot alike. That's exactly what I did.
Okay.
I looked at the M2 currency supply and the CPI, and I put them on a chart together. And this is what they look like. M2 is in blue, and the CPI is in red. And you can see that there's a lag effect. There are these waves of currency creation in blue, and then following it, there's a wave of inflation in red. And so there's a wave in blue and a wave in red. And this sort of follows a little bit throughout the time series here. It's obviously not perfect, but you can see that there is a lag effect. So what I started to wonder is, how big is that lag effect? Is there a way that I could offset the two data series by 1 month at a time and get the correlation, and then 2 months at a time and get the correlation, and then 3 months at a time until they overlap and have the best possible correlation? Okay. So that's what I did in Excel. So I crunched the numbers, and it looked like this. I went a little slower though. I didn't want to make a mistake. No, I crunched the numbers. It looked like this. So if there's no delay between the two data sets, the correlation is about 0.06, very close to zero, effectively no correlation. It's like the two data sets are random. But if you offset it by 1 month, the correlation goes up. By 2 months, it goes up more. By 3 months, it goes up, and so on. And you can see it keeps going up and up and up until 24 months delayed. And the correlation is the highest. It's 43%, about 44%. And if you offset it by more than that, it starts to fall again. So that suggests to me that if we want to know what inflation is going to be in the current month, we should just go back 24 months ago and look at what happened to M2. And that's going to be our best guess.
Okay.
What do you think?
That sounds perfectly logical to me.
So I would like for that to be a stronger correlation, but I don't get to choose. And then on a hunch, because as I was looking at this, I noticed that in the QE era, there's not quite as big of a delay. It almost looks like they line up a lot better, these waves. So on a hunch, I did the same analysis just looking at the modern era since QE, and it looks like this. So since QE, the correlation goes up and up and up, and it's at 19 months, it becomes the strongest, and it's a 73% correlation, not a 43% correlation. So it's much higher, and that currency hits consumer prices much faster. It only takes 1.5 years instead of 2 years.
Yeah.
So yeah, as we get the hyper financialization of everything, the currency hits things faster. That's really no surprise. So again, if we want to predict what's going to happen with inflation, we can go back 19 months and see, okay, what happened with M2. So let's do that. So 19 months ago, right now we're in September of 2024. So 19 months before that is March of 2023. So you can see that it was right about here. This is what happened to M2. So this descending line of M2 is largely why we've gotten a reduction in inflation the last few months.
But it's going positive again. It's bottoming.
We only have one more month of reducing M2. So again, it's not a perfect analysis, but we might only get one more month of falling CPI, and then it's going to go up. That's kind of what I take away from this, that inflation is coming back.
Well, also, if you look at the amount of currency creation that happened right during and after the pandemic, I go back to the chart that had both the CPI and this on there, shorten the time scale too, to just sort of focus up on since the right here. Shorten the time scale to about there. Okay, so the dip below the zero line for the M2 has not offset the big increase in M2. Now, a lot of this is in the markets, and so M2 doesn't just go to consumer goods only. It goes into real estate, and it goes into the stock market and so on. So we've had this reduced CPI, and it's going to be coming back, but I think that I think we've got big negative real rates coming, is my point. But there is inflation. We've got negative real rates that are coming. This is a hard one to figure out, but go on. This is a very good analysis of ways to predict this.
Yeah,
all of that currency creation, a lot of it was soaked up in the stock markets and so on. A lot of that, I think, is going to be vanishing soon.
Yeah. Well, we are almost at the end of the analysis here. Basically, the point is, if we want to know if the bull market in gold will continue, that's dependent on negative real rates, it seems. And we just said the Fed funds rate is likely to be around 3% or possibly lower if there's a crisis a year from now. And inflation is going to come back. So it's not a stretch of the imagination to say that inflation will climb from 2.5% where it is now to 3% or more. I mean, in 12 months, that's very easy. And that's all it has to do in order for us to get negative real rates. It's to 3% if that's where the Fed funds rate is. So it seems to me like negative real rates are almost a guarantee. The free market is sort of predicting it. The M2 currency supply is predicting it. I think the bull market in gold continues at least another 12 months. That's my thought.
I think that what people need to ask themselves since the year 2000, the dollar's purchasing power, gold was 250. Now we're over 2,500. So the dollar's purchasing power against gold is down by 90%. Do you think the dollar is going to gain in purchasing power? I think you are right. I think there is still stored up inflation because you didn't see that complete offset. So I think the interest rates, they're going to be at 3%, but we are going to see inflation higher than interest rates, giving us negative real rates. I think I think we're sort of in trouble when it comes to the markets. I think that the Fed, Ben Bernanke, has placed the Federal Reserve in a trap that they cannot get out of, that there is no way out of this. They can only make it worse. Every time they do more currency creation, it's going to make it worse. Every time they fiddle with interest rates, it's going to make it worse, because we're under this new era of Bernankenomics. and these negative real rates are going to persist on the average. You're going to see these little bursts like we've seen since the year 2000 of positive real rates, but this trend of mostly negative real rates is going to continue, and this trend of upward, gold prices going up and silver following, and then silver will blast past gold as far as percentage returns, and it's going to be huge. That is my take on all of this, because it's whatever you think the dollar is going to do, you got to bet on the opposite. But this is brilliant, your analysis with this time shift. I want to thank you for that.
Yeah, my pleasure. And thank you for sitting down with me. And thank you to everyone for watching. If you got gold, just, dance it up. Dance it up like this. Thank you, Mike. That's it for today.
Okay. Thank you, Alan.